Hi, friends. We may be having a little bit of technical difficulties, so we'll just post this later, and we'll just kind of resume the story. Okay, when last we met, our hero, the stock market, had crashed. It was 1929, and as a result, 1 in 5 Americans was laid off, and it had caused a worldwide depression. So today's episode is going to be about the next 60 years and basically how the stock market went from being villain to hero in the worldwide economy. But first, we're going to do a quick recap. Okay, the year is 1500. Columbus and other explorers go out over the horizon. They find new trade routes. They find gold. They find silver. They find all kinds of goods that they bring back to Europe and bring back unimaginable wealth. As a result of this, credit gets much more freed up. Now, credit had always been available. It had been available since the time of the pharaohs. But it had been very, very difficult to get. But when you're going out and you're finding new wealth and bringing it back, a lot more people are willing to take a risk. And therefore, credit after 1500 got freed up to people like you and I, and it fueled capitalism. So now it's 1792. We're in the United States, and the birth of the New York Stock Exchange is starting. It starts with a Buttonwood Agreement, where 24 stockbrokers meet under a buttonwood tree, a sycamore tree, and lay down the rules that are going to govern the New York Stock Exchange for the next 100 years. But what is the first thing they decide? Well, they know that Revolutionary War bonds have been sold. A lot of them are fake bonds, and it has caused the young markets to crash. So the first thing they say is, only the 24 of us are moral enough and have enough knowledge to trade. So the first rule of the Buttonwood Agreement is no one outside of the agreement can trade. Today, we would call that a monopoly. We would call that price fixing. We would call it collusion. But that is the way that it was then. So now that happens. But first, I want you to think about something. From the time that the stock market is formed in 1792, really the first 50 years or so, it's very informal. They're meeting in coffee houses. It's kind of a gentleman's club. From the 1790s to 1825, I want you to think of the stock market as a trip to the moon. Now, you know the moon exists, but you haven't been to the moon. And you don't know anyone who knows anyone who knows anyone who's been to the moon. That's how rare it is. And that's how rare it was to own a stock back then. From 1825 to 1860, things began to change slowly. It wasn't common, but it was like a trip to Mount Everest. Now, you may not know anyone who's been to the top of Mount Everest. I've never been to the top of Mount Everest. But you may know someone who knows someone who knows someone who's been to the top of Mount Everest. From 1860, the time of the Civil War in the United States, till 1920, there were huge upheavals in the United States, not only social upheavals, but economic upheavals. We were slowly changing from an agrarian economy, an economy that focused on farming, to a manufacturing economy, where we were building things, ships, boats, engines, radios, phonographs, all of these new inventions, and factories were being established to make them. So between 1860 and 1920, the stock market was kind of like a trip to Paris. I've been to Paris, some of you have been to Paris, but not all of us have been to Paris. And not all of my friends have been to Paris. But what happened in 1920 that eventually then caused the stock market to crash in 1929 and cause the downfall of the economy? Well, the stock market became not like a trip to Paris. For Americans, it became like a trip to New York City. You didn't have to get on a plane. You could drive there. So many more people went there. And what happened is it was the advent and the birth of mutual funds. Before we get into what mutual funds are and what caused the stock market to crash, we're going to talk about three concepts. The first concept is called margin. The second concept is what is a security? And the third concept is what is a commodity? So margin. Margin is when you're buying securities, not with your own money. You're borrowing it from the exchange, oftentimes at exorbitant rates, 20% a week, 20% a month. And the rules are that the exchange can call in, they can call your margin in, they can call your loan in at any time. It's usually due on a Friday. So if you get money borrowed to you on Monday, it's due on Friday. But they can call it back on Tuesday or Wednesday if they want. But in the 1920s, the stock market was roaring and people were buying on margin. They were borrowing money from the stock market and then buying something. It would go up in price. They would sell it. They would buy it. They would sell it. They would buy it. They would sell it. Does this sound similar? This was like the housing market in 2008 in the United States. It was basically a Ponzi scheme. And that's what happened in the 1920s. So in 1929, when the stock market crashed, it did not crash all in one day. What happened was stock markets began to get shaky around on a Wednesday because the buying and selling, some people were like, aha, I've had enough now. I've made enough money. I'm going to get out. I'm going to sell. So now prices began to fall a little bit. The banks got a little bit nervous and they called in some of their margin. And people were like, well, okay, I'm just going to sell my security to cover my margin. And here, Mr. Bank, here's your money back. And I'm still going to make a little profit. That was Wednesday. So by late in the afternoon, the markets recovered. And people were like, shoo. But Thursday came and there was more selling. And the banks again called in their margin, which triggered more selling. It wasn't yet a panic, but it was a lot of selling. Friday comes and things get really shaky just because margin is due, even without the banks calling in your margin. Those loans are due. So now you have to sell your underlying security, sometimes at a loss, to get any money to pay back the bank. So Friday comes, the stock market falls further, but the market closes. Over the weekend, there's a lot of rumors going around. Whoa, this thing's getting shaky. We don't know what's happening. And then everyone begins to hear about this. It takes a long time for word of mouth to spread, but it spreads. So what are you going to do if you own stock and you've bought it on margin on Monday morning when the stock market opens? The first thing you're going to do is you're going to sell because you can't take any more losses. So sure enough, Monday morning, the stock market opens, and over the course of that day, 16 million shares are sold, exchanges. A record that would not be surpassed for another 39 years. And then all of it, nearly all of it is to the downside. Margins getting called in, more selling triggers, more selling triggers, more selling, and the stock market loses massive amounts of its value. Now, what is the big deal? In the Revolutionary War, when we were selling fake bonds, the stock market, the economy of the United States didn't crash. Why is it crashing now? It was because people had bought stock in the companies that were the large manufacturing companies of the United States. They were making boats, they were making guns, they were making engines, they were making radios. They needed those profits and the money from people buying their stock to keep paying and hiring more employees. When that capital suddenly freezes, they know they're not going to have enough money. So they don't have enough money to pay their employees. So what do they have to do? You have to lay off employees. If you lay off employees, you can't make as many widgets, as many cars, as many engines. So if you can't make as many, you can't sell as many. And if you can't sell as many, you're not going to make a profit. So you either have to sell less for way more money, prices go up, or you have to bring prices down, which means less profit, and it became a vicious circle downward and the market crashed. And it drove a worldwide depression for the next 10 years. So what is a security? Because people were buying securities. A security in layman's terms, as simplest terms that it can be explained, is anything, an enterprise that is entered into for the purpose of making a profit. A company or enterprise that is entered into for the purpose of making a profit. So you buy something with the hope that it's going to go up in price. That is a security. What is a commodity? A commodity is a basic good. What is a basic goods? What is a basic good? A basic good is beef, flour, corn, soybeans, oranges. You don't go to the grocery store and buy an orange so that it goes up in price. You go to the grocery store to buy an orange so you can eat it. That is a goods or service. Why is that important for our conversation? Because at the moment, Bitcoin, out of the 19,000 cryptocurrencies that exist, Bitcoin is the only cryptocurrency that the Securities and Exchange Commission, which was established in 1934 to make sure that there were going to be no more stock market crashes, it is the only one that is recognized as a commodity rather than a security, which means it is not going to come under the purview of the Securities and Exchange Commission. It's a very strict commission. Okay, so now that has happened. Stock market has crashed and a lot of unemployment, a lot of hopelessness in this country and across the world. The stock market languishes for all of the 1930s and some of the 1940s. Then we enter into World War II. We need even more manufacturing because we need to fight the Nazis. And we begin to do what's called selling bonds, government bonds, like they did during the Revolutionary War, but this time they're not hoaxes. So Americans, to fight the war effort, are buying bonds. And that's slowly, because bonds are sold on the New York Stock Exchange, it begins to lift the prices up. However, the major thing that fuels the stock market to go up is mutual funds. A mutual fund you may think of as something really boring. You may not even know what it is. A mutual fund it gets its name from investors pool their money to mutually invest in something. That's what a mutual fund is. The first mutual fund happened in 1924, was founded in 1924. Today, in the United States alone, there are over 10,000 mutual funds. Globally, there are 131 mutual funds that have in them $27 trillion. So mutual funds begin to become very popular. People don't say to themselves, I'm going to buy General Electric stock. I'm going to buy RCA stock. I'm not going to do those things because picking individual stocks is very hard to do. But if you group them together and you put them in different groups, that averages out your risk. And over the next several decades, mutual funds make up the majority of the money and the traffic within the stock markets. When I was growing up, I heard a lot of people, a lot of teachers saying, I'm not invested in the stock market. I was growing up in the 1980s and 1990s. I'm not invested in the stock market. I don't own any stocks. At the same time, these teachers in the United States, if you're a teacher, you have what's called a pension fund. So that pension fund is what you get for your retirement, what you get for being a teacher, and if you're there for 25, 30 years, you get a pension. That pension is being invested in the stock market. So if you are a teacher, a fireman, any public job, you became invested in the stock market. Therefore, the stock market no longer became like a trip to the moon or a trip to Paris or a trip to New York City. The stock market in the 1980s, 1990s, and today for Americans is like a trip to the grocery store. Everybody's in it. Today, most employers have what's called a matching program. So you set aside a little for your retirement, a little of your paycheck that you get every 2 weeks, and your employer matches it. They match it within, but they invest it within the stock market. So even the stock market has become one of those things that even if you don't know that you are a part of it, you are a part of it. Why is that important? It is important because the total value of the New York Stock Exchange and the NASDAQ combined today is about $43 trillion. The total amount of money in all of the stock markets that exist in the world is roughly $60 trillion. And I have just said that in mutual funds, there's $27 trillion. Now, after the recession of 2008, a new investment vehicle was born, electronic transfer funds, ETFs. ETFs have become ubiquitous. They started out, there were a couple of them in 2008. Now there's over 8,500, and there are $10 trillion invested in ETFs. So between the $10 trillion invested in ETFs and the $27 trillion invested in mutual funds, you get to $37 trillion. Now you see what a portion of the 42 trillion is held by those, is influenced by those two vehicles. Those two vehicles have become what drive the stock market, not the value of any one particular company. You may say Apple stock is wonderful or Tesla stock is wonderful. They may be, but their total value only exists because their stock is held in so many different types of mutual funds, and they're being bought by money managers. Without them, the companies wouldn't be worth very much at all. Okay. Now, so that's the basics of what a stock market is. So the stock market, as you see, has become a very complex vehicle, but it's become a complex vehicle that the government itself is invested in. Currently, the United States is probably the global superpower. But as you saw in Russia, for example, also has enough nuclear weapons to end the world several times over. But the United States doesn't use its nuclear weapons, and thus far neither has Russia. We flex different types of muscle. And the type of muscle that we have influenced and why we have become the global superpower is because the United States flexes economic muscle. The economic muscle that it flexes is partially dependent upon the value of the stock market. So in 2008, when a lot of very bad decisions were made by bankers that politicians didn't know anything about, and the stock market lost 50% of its value in several months, the government came in, President Obama came in, and bailed out the banks, bailed out the automakers. $970-something billion was spent by you and me to bail out companies. Why? Because if that hadn't happened, it would have been a situation that would have been as bad or worse as the Great Depression. So the stock market and the big Wall Street banks have become, and you've heard this expression many times, too big to fail. What that means is that it's in the public's best interest for them to do well. You saw what happened in March of 2020. March of 2020, a global pandemic came. Societies shut down everywhere. China shut down. The United States shut down much of its economy. The stock market lost a third of its value in 2 days in March of 2020. It went from being over 30,000 to being 19,000 in about 3 or 4 days. The government stepped in again and said, no, 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 no. We are going to put in what's called stimulus money. We're going to inject money. In that case, they bought bonds to such a vast amount that it propped up the economy. It propped up the market. So why is this important? It is important because the S&P 500, which is an index of the top 500 companies in the United States, since 1970 has averaged a return of 10.46%. That means that roughly every 6 years, your wealth is going to double. So if you're going to do that, why would you possibly invest in any individual stock, or why would you invest in something like Bitcoin? So money managers are continually trying to beat the S&P 500. But the S&P 500 has an outstanding record, and that is because it now has the backing and the laws of the United States government. It's in everybody's best interest for it to succeed. For most of your money, and certainly most of my money, please have it invested safely in the United States stock market. Now you're going to say this US stock market is down 25% this year. Who cares? Over the course of time, it has evened out and will make a return. However, that same strategy is not going to work for cryptocurrencies. Cryptocurrencies, you cannot do a buy and hold strategy. The markets are too volatile. The markets are too young. The only way that we're going to make money, or I believe that you can make money in cryptocurrencies, is that you're going to have to buy and sell. You're going to have to buy when things are low. You're going to have to sell when things are higher, buy when things are low. Now, as you saw, that is very similar to what was happening in the markets before 1929, before the SEC was formed, the Securities and Exchange Commission was formed in 1934. Regulation is coming to crypto. It may take a while for it to happen, but it is coming. In the long term, it is going to be best for everyone, because let's remember what has fueled the tremendous growth of the stock market. Mutual funds. You and me and everybody else investing within it, even sometimes without knowing that we're investing in it, by being a teacher, being a fireman, having a retirement in there. There will come a day, not far from now, when there's going to be mutual funds, electronic transfer funds that exist for Bitcoin, Ethereum, all the other ones that we're doing. And they will become regulated and they will become legal. At that point, they will become part of mutual funds, part of index funds. That means that your teacher down the street, your neighbor, will be invested in Bitcoin without even knowing that they're being invested in Bitcoin. And what's going to happen to the price of Bitcoin or crypto when and if that happens? It is going to skyrocket. Why? Because Bitcoin is a commodity that has a fixed number of units. 21 million Bitcoin are only ever going to be created. If 21 million Bitcoin are going to be sold between a lot of people in America, how many people are in America? The majority. There's 390 million people just in America alone, 7 billion people in the world. If they become invested in mutual funds that have Bitcoin in them, the price of Bitcoin is going to be 6 and 7 figures. So the reason why we're buying Bitcoin today is the same reason why you should have bought stock before the market crashed in 1929. Because the future, the long-term future, is brighter than today. But it is not going to come without pain. It is not going to come without risk. And that is why we want you all to do it safely. I think at the moment, nobody else was able to get on, so I'm not going to take any questions. Please send your questions to us. I'll stop this recording now. We'll post it to the website. We'll post it to the Slack, and then you can ask me your questions online. Thank you all so much. Take care.